Ladies and gentlemen, good day and welcome to Q4 and FY23 earnings conference call of Nuvoco Vistas Corporation Limited. We must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risks that the company faces. The company assumes no responsibility to publicly amend, modify, or revise any forward-looking statement on the basis of any subsequent development, information, or events or otherwise. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Madhumita Basu, Chief Strategy and Marketing Officer of the company. Thank you, and over to you, Ms. Basu.
Thank you. Good evening, everyone, and a warm welcome to the Q4 and FY23 earnings call of Nuvoco Vistas. Looking at the year gone by, the financial year was dynamic for the entire industry. On one side, cement demand has shown robust growth coupled with improvement in prices from FY22 levels, with ease outperforming the all India average. On the other hand, soaring energy costs has impacted margins during the year. However, softening in the fuel prices from Q4 FY23 has provided support to margins in the later part of the year. On the economic front, the macroeconomic indicators demonstrate a positive outlook for the sector as annual consumer inflation in India eased to 5.7% in March 23. Manufacturing and investment activity is expected to increase in the economy due to the government's emphasis on capital expenditure, better capacity utilization in manufacturing, double-digit credit growth, and moderated commodity prices. With the government's continued focus on developing infrastructure and rural housing, cement demand is expected to remain strong in FY24. Coming to the industry performance in FY23, cement demand in East and North have witnessed robust demand growth during the year, driven by rural housing and infrastructure. However, looking at the regional dynamics, especially the states of Bengal and Jharkhand, witnessed subdued demand growth during the year, moderating our overall sales volume growth during the year. However, we have stayed focused on our premium products and on trade volumes in FY23, and this will continue to be a major thrust area for us. Nuvoco has one of the highest cement to clinker ratios in the industry at 1.82, with continuous focus on blended cement. Prices have improved from FY22 levels, with East at 7%, outperforming all India average of 3%. However, price increase in FY23 has not been adequate to contain pressure from the high energy costs. Given this environment, I now move on to sharing some strategic and operational updates. Continuing our thrust on premiumization and innovation, we have successfully added Concreto Uno, Duraguard S2S, and Concreto Glide to our premium product portfolio during the year. We have sustained investment in brand building with focused brand association programs for brand Nuvoco. We have launched on digital platform engagement films as a marketing communication campaign for brand Duraguard, which showcases its unique selling points. The campaign has been well received, attracting more than 10 million plus impressions with stakeholders. An update on our projects. We have been prudently prioritizing our capex on sustainability, debottlenecking, payback-based projects, and north footprint enhancement. A quick update on our ongoing growth and debottlenecking programs. Cement capacity expansion to 1.2 million ton per annum grinding unit at our Bhiwani cement plant in Haryana is ongoing. Civil and fabrication advancement is on mark, and all major orders have already been released and deliveries are on track. This will take our overall cement capacity to 25 million metric tons per annum. The alternate fuel co-processing and pre-processing systems have been commissioned at Vistas and Nimbol. This will facilitate our handling of a wider range of alternate fuels with increased waste recycling tonnage in FY24. Railway siding projects are on track at both Jajpur and Sonadi, and commissioning is planned later in the financial year. Clinker capacity enhancement at Rishta and Nimbol are on stream within H1 FY24 deliverables, and the latter will support our grinding unit expansion in Bhiwani. Ready-mix operations. Our ready-mix concrete business has seen improved revenues by 24% in FY23, with premium products and new products comprising almost one-third of the business. We see the ready-mix business gather momentum and will utilize this opportunity to ramp up our pan-India RMX presence. Our commitment to this business is demonstrated by back-to-back commissioning of our Guwahati and Coimbatore plants. I share here with pride that the Guwahati plant is the first all-women-led ready-mix plant. Modern building materials, the company remains committed to offering a diversified range of products to meet our customers' construction needs. This business has recorded a near 20% growth in FY23. On the people and processes front, at Nuvoco, we recognize people and processes as key to remaining agile and competitive. In the year under review, the company launched the Nuvoco University, a platform to upskill people via e-learning and classroom training. The company has in place program lead for process-oriented performance improvement and Project DEN to digitally enable internal and external stakeholders. On sustainability, the company stays committed to its sustainability initiatives by concentrating on raising the consumption of alternate fuels and has exhibited an exit rate of 12% TSR in FY23. We have one of the lowest carbon footprints in the industry, with net carbon emissions at 465 kg CO2 per ton cementitious material in FY23. Primarily driven by good focus on blended cement, WHRS, AFR, and improving thermal efficiencies. Reiterating our commitment to sustainability, we have launched a company-wide program named POP, Protect Our Planet. This has been taken as a company strategic action and is chaired by an EXCO team. Activities encompass all functions and facets from sustainability roadmap to green concrete products, use of recycled construction and demolition waste in concrete manufacturing, reducing single-use plastic, and becoming water positive. Coming to the financial performance, for the quarter, cement volumes in Q4 FY23 stood at 5.2 million tons. Volumes remained impacted as key markets of Bengal and Jharkhand remained sluggish sequentially for 2 quarters. Our revenue from operations improved by 12% quarter-on-quarter to rupees 2,929 crores in Q4 FY23. Profit after tax for Q4 FY23 stands at 201 crores. On a full year basis, cement volumes improved to 18.8 million tons. Our revenue from operations improved by 14% YOY to 10,586 crores against a volume growth of 5% as the company prioritized value over volume growth. That for FY23 stands at rupees 16 crores. Key cost elements are focused on Q4 FY23. Cement raw material cost increased by 4% YOY due to increase in key commodity costs with inflationary pressure. This has been partially mitigated with long-term contracts for slag and improved cement to clinker ratio. Power and fuel costs increased by 11% YOY due to external pressure from high energy prices. However, on quarter-on-quarter basis, there has been a reduction of 14% due to softening in fuel prices coupled with higher thermal substitution rate. Distribution costs during the quarter primarily increased with the reimposition of busy season surcharge on the railway freight, coupled with increased road movement of clinker due to wagon availability issues. Our team is working closely with the Indian Railways and in an industry first has introduced innovative solutions for clinker movement such as bobby and wagons, which were typically used by railways for transportation of aggregates and track balance materials. Our consolidated EBITDA for the quarter improved by 41% quarter-on-quarter to rupees 383 crores. We have been continuously working to strengthen our balance sheet. Our net debt at the end of March 23 declined to rupees 4,414 crores with a focused drive on collection coupled with efficient working capital management. Our interest cost has also been effectively contained with an increase of about 160 bps against the increase in repo rate by 250 bps since March 22, with opportunistic refinancing and debt repayments. Our capex spend for FY23 stands at 486 crores. Just to summarize before I open the floor for Q&A, the macroeconomic indicators are creating a buoyant outlook for the sector, and government's continuous thrust on infrastructure development augurs well for cement demand and prices. With government's focus on housing for all scheme and expectation of improvement in disposable income, we will continue to leverage our trade centricity to drive volume growth. Our growth projects in the north, including the 1.2 million ton per annum cement capacity expansion at Bhiwani and the debottlenecking in Nimbol, are both progressing well and will help to increase our footprint in the region. The ready-mix concrete business is on growth momentum, and we are actively ramping up Pan-India plant operations. Moderation in fuel prices will favorably impact margins, and we remain focused on continuous reduction of net debt and prepared for our next phase of expansion. With this, I will end my opening remarks. I am joined by Mr. Jayakumar Krishnaswamy, Managing Director, and Mr. Manish Agarwal, Chief Financial Officer, Nuvoco Vistas. We are here together to take your questions. Thank you. Over to you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. The first question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Hi, good afternoon. Firstly, I wanted to know, what was your clinker production in FY23 and what was the clinker utilization?
Management members, we are not able to hear you.
Look, in terms of Amit, so in terms of detailed clinker output and cement output, it will be very difficult for me to right away tell you in this call how much clinker we produced on a company-wide basis. Because internally we track cement production, and that's where we are at 18.8 million tons of cement sales, which we did. And at the beginning of the year in April 2023, we hardly had close to about 1.5 lakh tons of cement stocks. So whatever cement which got sold in this fiscal were all manufactured in this year, and the closing stock of cement was also hardly about 1.5-2 lakh tons of cement in the system. So that really go back to 1.8 CK ratio on 18.8. You can safely say close to about 10 million tons of clinker which we made. So that's the roundabout way of looking, but we still have headroom. On number of cases, we had to kind of, clinker capacity for the company is 11.88 million tons. Actual production for FY23 is 10.3 million tons, and clinker capacity utilization at 87.5%.
Okay, thanks. And also, your debt has dropped in Q4 quite significantly, and congratulations on that. But just to, if I go through the details, it seems like come through payables extension and payable days have gone up a lot. So how sustainable is this reduction in working capital and net debt in that context?
I will take the first part and then I'll ask my CFO to give you the details. As we have been telling in all our calls right from the beginning, the endeavor of the company is to keep a hold on debt in the short run, and so that we come into a manageable debt levels to the tune of about 4,000 crores thereabouts. Then we decide the next phase of expansion. So that's the view of the organization, and our efforts and endeavor has been in the last, ever since we listed the company, and going forward, we'll have to pay the debt so that we are ready for the next phase of expansion. So that's how in the last 3 years, March of 21 to 22 to 23, there is a continuous improvement in reduction of debt. Now I'll ask Manish to give you details about how we went about doing this.
So basically, I would say the teams have done a very good job in managing all the key levers of working capital. So all the 3 key levers comprising of on the receivable front, on the inventory side, as well as on the payable side. So as Nuvoco is a cement trade-centric business, so we have received full support from our cement channel partners, and we did a record collection in Q4. We have achieved a revenue growth of 14% in FY23. However, if you look at the financials, our receivables have remained broadly in line with that of last year. So this clearly indicates that there is an improved DSO as of March 31st, 2023. Also on the RMX side, we have continued to focus on driving sales on our cash and carry model, and we have also reduced our credit terms with our customers if I compare it with the past period. On the inventory front, there was significant buildup of inventory in H1, primarily on account of 3 factors. One is because of the seasonality involved, the cement and clinker stocks are generally high as of September end, and also because of the higher fuel prices that were prevailing at that point in time, coupled with the issue of uncertainty around the stocks on the fuel front. So we had to stop that side also. However, gradually from Q3 onwards, we have reduced inventory levels and brought it in line with the internal stipulated DIO norms. And also the fact that there has been softening of the fuel prices from Q4, and that's clearly evident in the financials also. The overall inventory value has reduced. The third key lever on the payable side, so I would say with the change post-COVID dynamics, we have been focusing on renegotiating our payment terms for raw material, fuel and other line items with our vendors, with our suppliers, and we have received an encouraging response to this. So that is how we have been able to bring down our working capital in a big way.
Okay. And was cash and carry the reason why like sales volume dropped YOY? There was a 4% drop in sales volume.
So he's talking about the ready-mix business.
The cash and carry comment was in respect of our ready-mix business, Amit.
So in the ready-mix business, Amit, we used to have credit terms which were excess of 90 days or even 120 days in the past period. So one of the things I mentioned in the previous call was the entire business model we revisited post-COVID when we resumed operations after the shutdown during the COVID period. So we took 2 or 3 levers at the time. First, we said we will operate our plants only in those markets where the NODT as well as the raw material cost is manageable from our perspective. Number 2, we also said that we will not supply to those customers who are expecting longer credit terms, and hence our business itself shrank in those days. We started selling much lower than the prior to FY19 times. That was the second thing. The third thing we also said was this entire concept of cash and carry which introduced, which means in ready-mix business there are a lot of small IHBs who will put a roof or something and then they buy ready-mix for 1 lot or 2 lots or 2 transit mixers. In those cases, we are very clear that we wanted to focus more on those cases so that we're able to get advance or cash and carry for supplying to those places, and hence credit exposure big time reduced. Last but not the least, one of the big efforts which we have been doing in the last year and a half is we don't do repeat sales to any customer whose credit is more than 45 days overdue, and hence this has greatly improved the overall receivable position in the ready-mix business.
Sure, thanks. I'll come back in the queue. Thanks.
Thank you. Ladies and gentlemen, we request you to please limit your question to 1 per participant at a time. If you have any further questions, you may join the queue back. The next question is from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, thank you. Just a couple of questions. Just within two questions. One on the very strong cash flow performance in the quarter. Just want to understand the moving parts for both DSO and inventory. On the DSO, I can understand very strong collection from the channel partners, but somehow we've not seen others being able to replicate that in the quarter. What was driving that very strong collection that you've seen outside of RMC in the purely cement business? Is there some element of bill discounting or vendor financing in that particular element? And on the inventory front, was there basically inventory liquidation for cement also in addition to fuel cost in this particular quarter? And why was there fuel cost? Does that mean the inventory of fuel costs was actually very high in a period when fuel costs were actually high? And where is the fuel inventory right now? Is it very lean given we are looking at a lower fuel price environment? So that's the question on working capital. And then I have just a quick question on incentives also.
Yeah. So Satyadeep, I'll go one by one. So first point was in relation to your the receivable front. So I cannot comment about the other companies per se in terms of DSO, but for us specifically, if I compare it from the last year, there is a reduction in the DSO. That's point number one. And as I mentioned in the previous question, we have achieved a revenue growth of 14% this year as compared to the last year. However, our receivables, if you look at the financials, they are broadly in line with the last year. That clearly shows there is an improvement on the DSO front. Secondly, on the inventory front, again, as I mentioned earlier, there are three parts to that. In H1, as in the cement industry, because of the cyclicality and seasonality involved in that, the clinker stocks and cement stocks are pretty high as of September, right? So that was the case with us also, and it gradually starts depleting from Q3, Q4, and we were able to get that sort of a benefit by way of reduction on the clinker and the cement stock. That's point number one. Point number two is with regard to the high fuel prices. You will recall in Q4 of last year and the Q4 of FY22 and Q1 of FY23, the fuel prices actually peaked up, right? So obviously this was reflecting in the inventory that we were carrying as of September also. Secondly, because of the uncertainty around the overall environment, we were carrying large stocks of fuel to take care of our production for Q3 and Q4. So that was also one of the reasons which was appearing in September. Subsequent to that, in H1, in Q3 and Q4, as I mentioned, the clinker stock depleted, the cement stocks reduced, the fuel prices started softening from Q4, and also the stock levels right now, we are doing a strategic buy and opportunistic buy as and when the situation demands. But obviously, if I look at the DIO for fuel stock, as of now, it is less than what it was in the month of September. So these are three factors attributed to the overall reduction in the inventory. And you can see from the financials, there is a significant drop in inventory to the extent of 350 crores from the last year.
Just to add to what Manish said, you all refer in our earlier calls, we have been saying that the linkage coal supplies are totally evaporated in H1 because of the power crisis in the country. Gradually from November, December to January onwards, the linkage coal availability also increased, hence our overall import of petcoke as well as imported regular coal content also somewhat reduced because we started getting linkage coal, and in our consolidated fuel mix in Q4 of last year we had a 19% of linkage coal, and that came down to 13-14% in H1 it was single digit. Q3 became 13% and Q4 it improved to 16%. So overall, we started getting local linkage coal, which helped us to pare down the stock of petcoke and imported coal. Last but not the least, our AFR consumption also increased in the last QOQ basis. Every quarter we have been increasing AFR from a 6% usage last year, we exited at 12%. There again, that also kind of substituted the overall inventory of fuel. So all in all, fuel inventory was under control because of more linkage coal, reduced price of coal, reduced price of fuel, and last but not the least, improved usage of AFR.
Just a quick clarification on, thank you for clarifying. Just one follow-up on that on the DSO front, obviously faster collection cycle from the customers. just want to clarify, was there any element of bill discounting, vendor financing, and did it have any impact on discount or incentives that the dealers demand?
So nothing as such, Satyadeep, in terms of bill discounting. But so this cash and carry, what I talked about was specifically to the RMX business. So as a percentage of overall sales, there is a sizable component of sales which is happening on the cash and carry model, wherein we get the payment in advance or within a period of 1 to 2 days. That is also helping us to reduce our overall receivables, which was not the case to that extent in quarter 4 of FY22. But obviously, there is no element of bill discounting for sure.
Okay, just if I can just squeeze one question on incentives. What were the incentives accrued in FY23, and what was the incentive received in FY23?
Hold on a sec.
So more or less similar?
So basically, we have incentives coming in from both East and North. So across all East and North, we accrued overall incentive value of close to 190 crores. And we were able to get a large part of it primarily from the incentives which was there in the Rajasthan. And on the east side, it's already there for 2 plants of Meja and Panagarh.
So fiscal 23, the incentive is close to 190 crores, out of which Rajasthan is close to 40 and the balance is East. And you would know that we had stopped accruing Meja a couple of years ago. And from this April onwards, we've decided to stop accruing Panagarh as well.
So how much was we received across both North and East, including Panagarh and North?
That's what I told you. It's about 190 crores last year, out of which North is 40, East is 150.
And entire 190 was received also from the government?
No. Rajasthan is the only state which does quarter-to-quarter disbursement. We received everything in Rajasthan. East is on accrual basis because that's been the case with West Bengal as well as Jharkhand. We just started a 1 year. So West Bengal is the one where Meja and Panagarh, so we've been accruing ever since the incentive scheme started. One was from the Lafarge times in Meja, and then 2 years into after acquisition of the Lafarge by Nirma, we decided to stop accruing Meja. And then when Imami came to our fold, they had already, they were accruing Panagarh. So at the time of acquisition, we continued with the practice for year and a half, and then this year we have decided that we will stop accruing for Panagarh as well.
I just want to understand, of the 140 crore that you accrued in East during the year, given the quarterly disbursement that you get from the government, overall, what was the amount received for incentive in East during the entire year for FY23?
So it is primarily from the Rajasthan plant that we got in FY23.
So East, this is not we have received all the money from the government.
Okay.
So why don't you reach out to our investor relations? We'll give you granular details, so you'll be able to give you all details when we meet. Not a problem.
Thank you so much. Thank you.
Thank you. Participants, we request you to please limit your question to 1 per participant. If you have any further questions, please join the queue back. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Yeah, thank you. First, a couple of data points. Trade share for 4th quarter, lead distance for 4th quarter, and Kcal cost for 4th quarter. Hello.
Shravan, I will just go 1 point at a time. You asked for lead distance. So lead distance is roughly over the full year about 340 kilometers. This on a year-on-year basis has remained rather flattish. In Q4 sequential quarter, we've seen about a 5-7 kind of kilometer improvement. But largely, I would mention that it has been flat. The question you had on fuel, the fuel consumption rate has been 2.31 rupees per Mcal on overall basis. And the question you had on trade share, so trade share has been on Q4 75%. Sorry.
Okay. Yeah. So now we have reduced the net debt significantly, 750 odd crore QOQ. So two things just wanted to know, as on today, the net debt number is same around the, I'm not asking the exact number, but broadly whether it has remained the same 4,400 odd crore net debt. Second, in terms of the expansion plan, so our stand previously was 3,500 crore, and we will go for a next phase of expansion. So our preference was north. So when will we start, and what the likely capex for that? And apart from that, for the even without that, what's the capex for this year we are looking at?
Okay, I'll just give you one at a time. First question was all about current debt at 4,400. So where to put the chart? Which is about the last 3 years, March to March, I think the debt has reduced from 5,400 all the way to every year, 3 years up to 4,400. In the past calls, I've been talking about the priority for the company is to ensure that debt levels are to the tune of about 4,000 crores or thereabouts before we start expanding, announcing the next phase of expansion. So we continue to be committed to what we have been informing you in the quarterly calls, and that doesn't change as we speak. The second one is about capex last year and the future capex. So last year when we, during our calls, we mentioned that the company is focused on brownfield expansions in Bhiwani, Sonadih, Jajpur, and Nimbol, and which in Nimbol we said will increase the capacity of clinker to 5,750 TPD. Bhiwani instituting the set up a GU 1.2 million ton. Sonadih is all about improving the logistics to get clinker movement out of Sonadih into eastern portion. And the last but not the least, Jajpur is the only facility in East which does not have a railway siding. We wanted to put up a railway siding there. All this had a capex outlay, including the routine capex as well as the land procurement and rest of all the stuff. We said we would invest close to about 550 crores, what we have been mentioning during your call. As we completed here, there's always a little bit of phasing and cash flows which happened. In FY23, as of 31st of March, we ended up spending 486 crores out of the overall projects which we envisaged during the year. Some amount of money will get spent in this year. As regards the capex plan for this year, we right now don't have any new projects at this point of time. We will continue to complete all the brownfield projects of Bhiwani, Sonadih, Jajpur, and Nimbol. And current outlay for all the projects is tuning to the tune of about 550 crores in this fiscal. We are also decided to set up additional ready-mix plants to the tune of about 12 to 15 plants. There we are parking close to about 25 odd crores to set up the new ready-mix facilities. So in all, last year 486 crores capex spent. This year our outlook for capex is 550 crores. Our debt levels in March 4,400 crores. Our endeavor will be, if the fuel prices tepid and the demand is as robust as it is currently and the prices hold in the market, we are looking at a reasonable period of time in the future to pare the debt to 4,000 crores. And then on we come back with our expansion plan, either in north or west, or we have the Nimbada site as well as Gulbarga. As I mentioned in our calls in the past, our primary focus at this stage is to expand in north through our north facility.
Thanks. So just to clarify, so maybe by next quarter or the second quarter, are we going to start spending for the north or the Karnataka expansion, and still the preference remains for the north?
I've been consistently telling in this call that on a quarter-to-quarter basis, we'll keep all of you informed about our starting of our greenfield facility either in north or west. At this point of time, this call, I'm informing you that in this quarter we don't have any plans to commence construction. I think when we reach the next call, I think we'll keep you updated every quarter about our plans whenever it will happen. But the primary focus, as we have mentioned in the last 5 calls, is the primary objective of the company is to pare the debt to about 4,000 crore level.
Okay. And last, sir, Bhiwani will start by...
Sorry to interrupt here. I would request you to please come back in the queue. Participants, a reminder to you, please restrict your question to one per participant. Should you have any further questions, you may join the queue back. The next question is from the line of Darshit from Robo Capital. Please go ahead.
Hello, am I audible?
Yes, you are audible.
Yeah, hi. So thank you for taking my questions. I wanted a basic overview of, say, revenue and margin guidance over the next, say, 2 years, 3 years span.
Okay, I'm afraid I can't make any forward prediction about revenue or performance of the company. All I can say is from the macroeconomic indicators and also the published reports from agencies like CRISIL and others, the entire outlook for the cement industry is to the tune of close to about 7 to 9% growth, which will be there. And of course, the reports which are prevalent, which all of you would have access to, is at a regional level, people are predicting different growth rates, and certainly in markets like East and Center, there because of the inherent nature of the underdevelopment, so there is the likelihood of better growth and higher growth in this region. That's one aspect on volume growth. Second one is again on price stable movement. Here again, I think the reports are out where people are looking at a better pricing outlook, and based on this year, East followed by West and North, with East followed by North and West will have better pricing than Center and South. So Nuvoco being a strong player in leading player in East and also decent position in North, I think we will have a better growth opportunity in terms of volume and also the pricing realization. If it happens, I think we will get a positive tailwind.
Okay. Thank you so much.
Thank you. The next question is from the line of Mangesh Bhadang from Centrum Broking. Please go ahead.
Hello, sir. Thank you for the opportunity. Sir, my question is with regards to the capacity that is getting added in the eastern region. Do you believe that even if the costs are going to come down from the current level, the profitability would remain volatile because of the competition that is increasing in East? And just if you can highlight what was the growth in eastern region in FY23 state-wise. Thank you.
I would not be having the details of state-wise growth for FY23. The overall growth would have been in the order of 8 to 9%. The states of Bengal and Jharkhand, as I mentioned in my call, has been somewhat subdued at 2%, and the rest of the states would be somewhere around that, between 5 to 8-9% kind of growth level. Answering your first question on the capacity utilization, as I have been mentioning in previous calls, that when we look at the eastern demand, we should look at it in the perspective of the clinker utilization. So if we were to go back to FY22, because the FY23 figures are yet to be updated on a running basis, so FY22 clinker position was about 43 million tons of clinker. And at a 1.6 kind of clinker cement factor, that translates to about 72 to 75 million tons of cement. Give or take another 10 million tons of cement coming in from the central region. So we are looking at East getting having a capability of up to 80 million tons of cement, and demand which is in the region of 70 to 80 million. So it was standing at a 90% capacity utilization. Over the last period, we are mentioning a 10 million ton kind of cement clinker addition of about 10 million tons with some new announcements. This is looking more like a 12.5 million ton. I don't think the 2.5 million ton additional, which is expected to come in by FY25, is going to radically rock the boat. We are still seeing clinker capacity utilization at somewhere around 7 to 88%, And it would be probably right to say that at any point in time, when clinker and or cement capacity utilization crosses an 80 to 85% kind of level, prices have a propensity to improve.
And very helpful, ma'am. Just you can leave me with the timeline for the Bhiwani expansion, when it will get commissioned. That will help.
Sorry, can you repeat the question, please?
When will Bhiwani get commissioned?
Bhiwani will be operational this year in H1 itself. We hope to make our first dispatch from the plant before H1.
Thank you, ma'am. Thank you. That's it.
Thank you.
Thank you. The next question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Just a clarification, to my earlier question, you mentioned the clinker capacity is 11.88 million tons. Haven't it gone to 12.5 after the couple of debottleneckings you did across the units?
Yeah, it will go. Currently, Nimbol capacity is still under commissioning. So I guess at the end of H1, when we talk, we would Nimbol would have got commissioned. And then the Vistas also has got a commission phase 1 and phase 2. While the majority of work has happened, during this year's annual shutdown, that's when we'll connect the higher capacity blowers which are needed. They're all in place, but during the shutdown this year we will do it. Post the shutdown and annual shutdown in Vistas this year, and post the commissioning of Nimbol, whatever capacity which we mentioned will happen, maybe H2 of this year should happen. Right now, I think with that available clinker, we're able to feed the market. But by H2 of this year, we'll have all that number in place. Both in North, we'll have 6,000 TPD of Chittor, 5,750 TPD in Nimbol, and likewise in East, which will have 11,500 TPD of Vistas, 6,000 TPD in Sonadih Line 2, 4,350 TPD in Line 1 Sonadih, and 5,250 TPD in Arasmeta. So that's the capacity which we will reach by September this year.
Got it. And on AFR, the projects that you have, I believe you target to go to 20%. So what is the commissioning schedule of those projects?
Vistas is fully commissioned. So we have AFR facility in Chittor, which is the oldest plant which has been processing AFR. There the TSR reached as high as 35% in Q4 of this year. So that there is no capex, so they will continue to operate at peak capacity. In Arasmeta, it's a very rudimentary AFR. We continue to use whatever availability there. We did not invest in Arasmeta. In Sonadih, again, no investment. However, we have close to about 6% of AFR consumption in the lines, both lines put together in Sonadih. The investments which we made were there in Vistas and Nimbol to the tune of close to 50 odd crores in both the plants combined together. Both of them had a pre-processing and co-processing facility. Happy to inform Vistas, both pre-processing and co-processing commissioned, and that is well and truly running as we speak. In Nimbol, the co-processing is commissioned. Pre-processing shredder is under commissioning in this week, early next week it will be completed. So when we hit June 1st, we'll have Nimbol fully capable of doing pre and pro. Vistas fully capable of doing pre and pro, and Chittor anyway does post only at high level. And with all this put together, we're looking at excess of 15% TSR at an average level from July 1st onwards.
Thanks. That's all from me. Thank you very much.
Thank you. The next question is on the line of Rajesh from HDFC Securities. Please go ahead.
Yeah, hi sir. Good evening. Am I audible?
Yes, Rajesh.
Yeah. Good evening, ma'am. Ma'am, two questions. First, I see your cement to clinker ratio for FY23 has improved significantly and is now at close to 1.83 versus 1.74 or 2 years back. So, do you see an opportunity to further enhance it to, and if to what levels? And second, when you mentioned 15% TSR you would be achieving from Q2 onward, that's a sizable increase. And in that context, what would be your average per kilocal costing, given that your current fuel mix cost is around 2.3 rupees?
But Rajesh, I will take your first question first. Yes, we opportunity to improve our cement clinker ratio further. Firstly, the actions which we have taken is significant increase in concreto cement, which is slag cement, introduction of PCC cement. Today, Panagarh as well as Jajpur and Doddabara plant have practically shifted fully from PPC to PCC cement. We see opportunity to take the shift, and we are planning in our Mejia plant. So roughly speaking, over a 2-year period, the outlook is going up from 1.84 blended across the country to 1.92. What we have not factored into these calculations, and we hope to see a good upside there, Rajesh, is the introduction of LC3 cement in North.
Great, ma'am. And on the CSR costing, AFR costing?
So on the AFR, firstly, on the robustness of 15%, as Jay explained, we have invested in our facilities, and that's going to give us this increase. To give you a little bit of perspective on the numbers, 9% AFR in mid-year, 4% last year, went up to 9% in H1, and we have exited at 12%. To give you a perspective on the overall fuel cost in today's reference, as I mentioned some time back, overall fuel cost blended was about 2.31 mcal, and AFR and ratio is 1.6. We have roughly seen a 1:2 ratio on the overall blended to AFR in terms of mcal.
Just building further, Rajesh, if you really look at AFR, the components of AFR basically are carbon black, then you've got recycled plastic, and you've got bio-waste. That's typically what one processes in AFR. And till about 2 years ago, the general arbitrage of AFR vis-a-vis the fuel blended cost of fuel, solid fuel, would be typically 1. So if the fuel cost is about 1.5 or something, AFR would be coming at the rate of about 0.75. That's the kind of rupees per million cal one was getting. But what has happened in the last 1 year is, with so many companies in the sustainability agenda have started trying to use AFR in not only in cement, in other industries as well. And we all know carbon black is like a like-to-like substitution for a petcoke or a almost nil ash coal. So the rate of carbon black is more or less trending at much higher level than the old rates of AFR. And hence the original arbitrage of ₹1 per million cal is kind of reduced to about 60-70 paisa. So this is a little bit of background I am just telling you, because we have to source carbon black in all our plants. And secondly, currently there is a little bit of a shortage of carbon black, so everybody wants to use carbon black. And hence, to obviate that, one of the things which in Nuvoco we have done is to get the pre-processing facility where we can go and shred all the other raw materials, and hence we went decided in Rizza and Nimbol will do the shredder option to maximize AFR. So having said this, so we're really looking at close to about the current rate of 12 to 15%. Our target is our fuel bill should be anywhere between 25-30 rupees per ton, positively impacted by use of AFR.
Great, sir. That's heartening to know. And lastly, on the incentives this year, now this Panagarh 140 crore which you billed, accrued last year, and now they won't be getting accrued next year onwards. So I see that if I look at from the current year, if I remove 140 crores from the reported EBITDA, that would have an impact of around 80 rupees per ton. So, in that case, 660 rupees EBITDA per ton, 600 rupees. So how do you look FY24 when your sizable amount of incentives want to be accruing in FY24? How do you see margin trajectory?
So basically, as Jay mentioned just a few minutes back, Mejia we had already stopped accruing.
Correct.
Right? in FY23 we accrued only Panagarh incentives, right? So the impact of not accruing it from FY24 is just 40 rupees and not 80 rupees. So that's the clarification I wanted to bring in.
Oh, this year you accrued 140 crore is what you had mentioned, right? From the out of 190 crore.
So multiple incentives in Panagarh, Jharkhand. That is what we mentioned. Out of 190 crores, 40 is in east and about 150 in 40 in north and 150 in east. However, next year we will continue to accrue Jharkhand. It's Panagarh there because it's taken many years. We have made a decision to be conservative and not start accruing from April, and hence around 40 to 45 rupees per ton. It will have a reduction in accrual.
Okay. And on the fuel side, what sort of savings purely on the landed cost of fuel currently versus full year average FY23? What would be the number? FY23 average KCal.
Give you some petcoke prices, I will tell you. So in terms of fuel per rupees, it's a function of linkage coal, it's a function of AFR, all of it. However, I'll do purchase price of petcoke. I will say it used to be in March 22. All of us know it went to as high as $250 per ton. And then somewhere in January, February, it came to about 150 to 160 USD per ton. And currently, as early as late as last week, we have booked at 133 USD per ton. So obviously, the numbers have come down. And rupees per million cal, which used to be 2.67, 2.8 rupees per million cal in north, it has come to about 1.95 rupees per million cal. So that's only petcoke, but then I have to use petcoke plus linkage coal and non-linkage domestic coal. All of it in FY23 was at 2.49. I am really looking at this number coming to, in Q4 it is 2.31 the blended rate. So I'm really looking at this number further going to about 2.1, just about 2.1 is the number as we speak at current levels.
Okay. Great. Welcome.
Thank you. If you have any further questions, you may join the queue back. The next question is from the line of Prateek Kumar from Jefferies. Please go ahead.
Hello. Yeah, good evening. Good evening, ma'am. My first question is on your volume mix. So we have reported this 5-6% volume decline, so largely attributable to two markets. So how much these two markets constitute in overall volume mix for us?
So Prateek, Bengal, Jharkhand and East is about 50% of our volume. But however, I would like to point out that on a full year basis, our revenue growth has been 14% against a volume growth of 5%. And this is primarily because of our executive decision to prioritize value over volume growth.
Right. So Bengal plus Jharkhand accounts for 30% of the overall volume sold by the company.
50%, roughly 50%.
50%?
Yes.
For East volumes?
East volumes.
Of the East volumes, okay. And secondly, on the fuel cost, you indicated like in the last question, but on overall basis for FY24, based on current spot trend, so can we expect like a 200 per ton reduction in cost, fuel cost for the company?
It will be very difficult for me to predict a number, but then I can only say that we are targeting from Q4 actuals another 100 rupees is the kind of number we are looking at.
Sure, sir. These are the questions. Thank you.
Thanks, Prateek.
The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Yeah, thank you. Sir, just continuing the previous question, just trying to understand the degrowth for this quarter in terms of the volume. So in the totality, you mentioned the 50% West Bengal, Jharkhand is the 50% of the East, but in the total volume, what's there said? So is it fair to say that we have also seen a reduction in the volume decline in other states also, because the math doesn't work just because of the two states if there is a decline, or the decline is so significant that it impacted the overall volume decline for this quarter?
Shravan, as I mentioned, on a full year basis, our revenue growth was 14% and volume was a 5% growth. This was an executive decision to prioritize value over volume growth. We believe it has reflected well in our realization per ton at 7% from, I'm sure you are also reviewing the industry figures. We've largely been seeing figures of the nature of 3, 4, or 5%, and we believe at a realization per ton of 7% improvement, it augurs well for our performance this year.
No, ma'am. Actually, my question was pertaining to only fourth quarter. So this 5.3% volume decline for fourth quarter, is it only because of the West Bengal and Jharkhand, or is it the case that we have also there is a degrowth in other states also we have witnessed?
Demand growth has largely been sluggish in Bengal and Jharkhand.
Okay. And what was the fuel mix for this quarter? Petcoke, imported coal, linkage coal, and then the AFR?
We clarified those numbers at the start of the meeting, Shravan. Linkage coal in Q4 FY23 was 16%, and petcoke was about 54%, and AFR was 12%.
Okay. Okay. Yeah. Thanks.
Thanks, Shravan.
Thank you. The next question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Yeah, just thanks for taking me again. So just on the slag cost, in the last quarter you had mentioned that the slag cost is moving up. Could you give the number for Q4?
I think details Mita will give you through a separate call, but suffice to say that the current market rates for slag is anywhere between 1900 to 2100 INR per ton. It's kind of carries more or less equal to the past value clinker cost. So that's the kind of irony which is there. But then we are kind of safeguarded by our long-term tie-up in Jamshedpur as well as Jajpur from the Tata plant as well as the Kalinganagar plant. So we have little bit of a, not little bit, sufficient breathing room with 2.5 million tons of slag contracted. But the trending rates are 1900, 2100. I think many of the latest auctions, we have simply walked away from the auction price like some of the other cement manufacturers as well. So I believe that as we go forward, this rates have to temper down because people eventually have to pick up slag, and this rates, everybody will have a rethink on contracting slag.
Okay, sure. Thanks. Yeah.
Thank you.
As there are no further questions, I would now like to hand the conference over to Ms. Madhumita Basu for closing comments.
Thank you, everybody, for attending our call. We've had fairly detailed discussions, and we hope to have addressed all your queries. However, my office and I remain available for any further clarification. Please do reach out to us. I wish you all a good evening ahead. All the best. Thank you once again.
Thank you. On behalf of Nuvoco Vistas Corporation Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.